Hello class, this is Dr. Fenton. In this video, we are going to cover Chapter 5 of the textbook, and it talks about cost, volume, profit relationships. So, let's get started. Now, managers will use cost, volume, profit analysis to make various decisions about the company. Now, the primary purpose is to estimate how profits are affected by the following 5 factors that you see here. So, selling prices, sales volume, like number of units sold, unit variable cost, total fixed cost, and finally, the mix of products sold. We're not going to worry about this last one very much. So to simplify these CVP calculations that we're going to go through, and we have several to go through, we're going to have various assumptions here. We're going to assume that the selling price is constant. We also are going to assume that costs are linear and can be accurately divided into variable and fixed components. The last one, don't worry about too much. It does talk about multi-product companies and the sales mix of the products will be the same. That's fine. But we're not going to worry about this too much, just as we're not going to worry about number 5 up here, the mix of products sold. Here's the scenario. We have Prem, who has started a company, and his company manufactures speakers, car speakers. Well, he sends them over to Taiwan to have them manufactured and shipped over here. And so Prem wants to know some information about his company. So down here that I have highlighted, he says, what would happen if a competitor entered the market and our sales slipped? In other words, they dropped. How far could sales drop without putting us into the red, which means make a loss? Another question he's been trying to resolve is how much our sales would have to increase to justify the big marketing campaign the sales staff is pushing for. And also he wants to know, the sales staff is always pushing to drop selling prices, and he agrees with them that lowering the price will boost sales volume, but he's not sure the increase in volume will offset the loss in revenue from the lower price. So Bob is the accountant, and Bob says it sounds like these questions are all related in some way to the relationships among our selling price, cost, and volume. So this is the cost, volume, profit analysis that we are going to look at. Here's what we start with. We have the company's contribution income statement. Now notice this income statement. We saw this back in Chapter 1, I believe. And we have sales, but then we subtract variable expenses. That gives us contribution margin. Then we take away fixed expenses, and then it gives us net operating income. So, variable expenses and fixed expenses, these are minuses here. They don't show the minus sign, but we're subtracting these. Now, our typical income statement, the one we have to use for external, stakeholders outside the company, it starts with sales. Then we deduct cost of goods sold to get gross profit. After that, we deduct operating expenses to get net operating income. But in this book, in this course, we're trying to analyze the numbers a little bit deeper. So this is a format of a statement that we can use within the company that might show us more useful information. So right now they are selling 400 speakers. The total revenue is $100,000 because the 400 speakers times the per unit selling price of $250 equals $100,000. Now the variable expenses is computed by taking $150 per unit for variable cost times the 400 speakers, the units that we are selling. So 400 times 150 gives us $60,000 in variable expenses. So subtract variable expenses from sales, sales revenue, and that gives us contribution margin of $40,000. Now we learned earlier that the definition for contribution margin is revenue, or in this case sales revenue, minus variable expenses or variable cost. I will commonly say revenue minus variable cost. It means the same thing as sales minus variable expenses. So contribution margin is the amount that your revenue exceeds your variable cost. In this case, $40,000. And then the $40,000 is used to pay for the fixed expenses. After those are taken care of, then we have net income, in this case net operating income. So this is a new format income statement in this course. So it's revenue minus variable cost, that gives us contribution margin. Take away fixed costs from that, that gives us net operating income. And just talked about contribution margin. And if you notice, going back up, I always see it right here. If you notice, the sales price is $250 per unit. The variable cost is $150. So that means per unit, the contribution margin is $100. Now this, as the writing up here says, this is an extreme example to show you exactly what contribution margin is and what it goes for, what it helps pay for. So let's just say, for example, again, an extreme example, the company sells one unit only one unit. Well, at $250 a unit, and it sells one unit, the revenue is $250. Variable expense, one unit, $150. Subtract, our contribution margin for one unit is $100. Now, if our fixed expenses are still at $35,000, we have a loss of $34,900. So again, an extreme example, but hopefully this makes clear what contribution margin is, and that it helps to start to pay for fixed cost, even though we don't have very much right here. And then the net operating loss is $34,900. Let's take another extreme example and say we sell 2 speakers. So we sell 2 speakers at $250 each. Revenue is $500. Variable expenses, 2 speakers times $150, $300. Subtract, our contribution margin is now $100 more. So if we have $100 like up here for 1 unit, then we have $200 contribution margin for 2 units. That's going to help pay for, very little of the fixed cost. So we subtract these out, and our net operating loss is only $34,800 for 2 units if we sell, as compared to $34,900. So this is showing you that per unit, our contribution margin is $100. So that means for every unit we can sell, then we have $100 per contribution margin. Let me back up to here. Look at this one again. So if we have $100 per unit contribution margin, and we sell 400 units, multiply, and our contribution margin is $40,000. Now they want to know how many units do we have to sell just to break even. And break even, just like it says, you're not making a profit, you're not making a loss. Your net operating income is 0. So they found out that they need to sell 350 speakers to have a break-even point, a net operating income of 0. 350 speakers times 250 gives us revenue of $87,500. Variable expenses will be $150 per unit times 350 units, $52,500. Subtract, our contribution margin is exactly $35,000, which is exactly what our fixed cost will be. So at the 350 unit level of sales, we're at the break-even point. We don't have a profit. We don't have a loss. We're going to see in a few minutes how to calculate the break-even point in a quick manner. But if you know your break-even point, that's the point where you're not making a profit and not making a loss, because your contribution margin equals exactly your fixed expenses. Now, just to show you what happens if we go 1 unit past the break-even point. So now if we sell 351 units, then here's the revenue, here's the variable expenses. The contribution margin is now $35,100, and the extra $100 comes from selling 1 more unit past the break-even point. And so take away the fixed expenses, $35,000, and our net operating income is now $100. So if we are 1 unit past the break-even point, our net operating income will equal the contribution margin for 1 unit, $100. This next example is asking, okay, if we are currently selling 400 speakers, what will our increase in net operating income be if we sell 425 speakers. Now, there's a quick way to do it right here, and there's a long way to do it. They both get the same answer, 2,500. The quick way is to say, well, if we sell 25 more speakers than where we are currently, 425 minus 400, so we have 24 more speakers, more units we're selling, and our contribution margin is $100 per unit. Just multiply, and our increase in net operating income is $2,500. So this goes back to what we've been saying. Every extra unit you sell will provide another $100 in contribution margin per that unit. So if we sell 25 more units, total income will increase $2,500. This is the short way to calculate that. It's accurate. Here's the long way. Here's the current data. We saw that earlier. Now work through the numbers with 425 speakers and multiply 425 times the unit selling price times the variable cost, subtract. We have contribution margin of 42.5, subtract the fixed expenses, 7,500, and now subtract where we were at 400 minus where we are at 425. There's the $2,500 increase. So this entire cost volume profit analysis is showing you quick ways to get your answer. You don't have to go through these long statements again, find the differences. Once you know more about your numbers, you can quickly calculate the results and then know what to expect if you hit those numbers. Here is the cost volume profit relationship in equation form. I don't care about this form that much, but let's go through it real quick. So your profit then is equal to, and this is like an income statement, sales minus variable expenses, and then take away fixed expenses. And of course, that's going to equal your profit. To spread this out further, our sales, or our revenue, will be the price per unit times the quantity we're selling. Then we subtract the variable cost per unit times that same quantity. This, within the parenthesis, gives us contribution margin. Subtract fixed expenses, and that's the profit. Okay, so really nothing new here. It's just in equation form. Now for a graph, and I really like these graphs, so I want you to know these. It's called the CVP graph or break-even chart, either way. What we're going to do is, first of all, step one, we're going to plot our fixed cost line. So before you put down the others, place your fixed cost line here, and we know that we have $35,000 in fixed expenses. Whether we sell 0 units or 700 or 800 units, fixed expenses will be the same, straight across. This is dollars, these are units. Now plot the total expense line. So what we're going to do is place the variable cost on top of the fixed cost all through here. So make sure you know that this is not called the variable cost line. This is the total cost line. We're placing, yes, variable cost on top of fixed cost, but then that gives us total cost. So at 0 units, our total cost is our fixed cost. And as you sell more units, our variable cost will keep going up. And the third thing we plot is the revenue line. And so if we do not sell any units, we're at 0. And then we go up the rate of $250 per unit, which is the selling price per unit. And that goes up, and that's how you plot that line. Let's add more to this. Let's scroll down. And here's a chart with more information for us. Again, fixed cost line, total cost line. This difference between here and here will be variable cost. This is fixed cost, but added together, that's total cost, total expenses. Our revenue line is steeper because we're selling the product for more than the variable cost. So it goes up like this, total revenue. And now you can see what we talked about earlier. Here is our break-even point at 350 units, break-even point. This shows us the sales dollar amount, and the units to break even. That's when the lines cross. That's when the revenue line finally gets above the total cost line. Anything back here, you can see this is the loss area. This area represents losses at each unit. So at the very beginning here, if we don't sell any units, our loss is $35,000, the fixed cost we have to pay for. Then as we start selling more units, our contribution margin we earn starts paying for those fixed costs. Our loss gets smaller and smaller until finally we hit the break-even point. Once we go past the break-even point, then here's the profit area. And so the further we get past the break-even point in number of units sold, our profits are larger and larger. They gain larger. So make sure you know each area in this graph, each line in this graph. So once again, fixed cost line, total cost line, total revenue line, loss area, break-even point, profit area. I'm not too concerned about this graph. This is a profit graph. I don't pay attention to it too much. Don't worry about it. Now we have the contribution margin ratio. It's easy to compute. The contribution margin ratio is simply your contribution margin in dollars divided by your sales. And that's the ratio, in this case 40%. Going back to our original numbers here, $40,000 divided by $100,000 is 40%. The variable expense, you can take the $60,000 divided by 100, it's 60%. So we can break sales, variable expenses, contribution margin, not only in per unit amounts, but also in percentages. Okay, that's what we just went through. Once we know these percentages, we can use them to quickly calculate the results when some items change. So what they're doing here in this example is saying, okay, what happens to our net operating income if our sales increase from $100,000 to $130,000? Well, you can go through all this information again. Here's your current situation, then have your sales, variable expenses, contribution margin, fixed expenses, net operating income for this level, and find the differences. And you can see if we go from $100,000 in sales to $130,000 in sales, our net operating income will increase $12,000. This is the long way. If we know that percent of contribution margin, 40%, we can make one quick calculation and it replaces all this information here, all these calculations. What is that? Well, take the increase in sales times the contribution margin ratio of 40%. 0.4 times $30,000 gives us $12,000 in extra contribution margin, which goes straight to the bottom line. So that's where we get the $12,000. So once we have this information, we can do it a quick way to save a lot of time, or the long way. Current, the new situation, the difference, to find the same answer. Given what we know now about how sales prices, variable cost, and fixed costs relate to each other, let's start changing a few things and see the results. So here we go. We're currently selling 400 speakers per month. That's the same number we've used so far. Now, the sales manager feels that a $10,000 increase in the monthly advertising budget would increase monthly sales by $30,000 to a total of 520 units. So look here, we're changing the fixed cost for the period. Advertising going up $10,000. We think we can sell more units. So would this pay for itself? If we spend $10,000 more in advertising and increase units to 520, will profits be higher or lower? So here's the situation. Current, we've seen this before, and now here's the new. Here are the new sales, $130,000, and we use the 60 and the 40% to get these two numbers quickly. Now the fixed expenses go up $10,000. So we're at $7,000 in operating income. Then if we believe these numbers will actually be hit, with the sales amount, by spending $10,000 more in advertising, we will be better off by $2,000 to increase advertising and then increase sales. Hopefully sales will increase. So we're better off by $2,000. And there's another way you can compute it if you want to. $130,000 in sales, that's your contribution margin, 52. Your contribution margin before the change was at 40. So our increase in contribution margin is $12,000. Our fixed expenses went up by 10, and so the net operating income increased by $2,000. An even shorter way to calculate the same answer is, okay, if our sales volume goes up $30,000 and our contribution margin ratio is 40%, then $30,000 times 0.4 is $12,000. That's the increase in contribution margin. Incremental means increase. And our incremental advertising expense went up 10 and $2,000. So you can make the calculation right here, or you can do it this way, or you can do it this way. But once you know more about your numbers, the contribution margin, that ratio, sales, fixed cost, variable cost, you can start making very quick calculations to get the answers you're looking for. In this next example, they want to increase variable cost this time by $10 per speaker. I think they're going to make higher quality components. And then the sales manager feels like they would increase sales to 480 units per month instead of 400. So let's increase variable cost $10. And what that does then, it drops the contribution margin down somewhat by $10, in fact. It was 100, now it's dropping to 10. Again, this is because variable costs per unit are changing. So we were at $100 contribution margin per unit. If we increase variable cost per unit, our contribution margin will drop by that increase. So now, if we can sell 480 speakers, but only get 90 per speaker in contribution margin, then $43,200 is our new contribution margin. Let's compare that to our old, where we are now, $40,000. And so we would expect contribution margin overall to increase $3,200. So we changed a couple of things here. We changed the variable cost, we changed the number of units sold, and then we can make a quick calculation to get the result. So in this case, it looks like contribution margin would indeed increase. In example 3, we're going to change a couple of things. So let's see what we're doing. We want to cut the selling price by $20 per speaker, so per unit, and also increase at the same time the advertising budget by $15,000. So we are cutting the selling price and increasing fixed cost. If we do this, the sales manager believes that this will increase sales by 50%. So we would go from selling 400 speakers, and 50% of that is 200, so add 200 to the 400, we would go up to 600 speakers for the amount we would sell each month, so 600 units. So should we do this? Well, first of all, I have to remember, if we decrease the selling price down $20 per unit, that would decrease the unit contribution margin by 20. It would go down to 80. So we went back to the original numbers where we had $100 per unit in contribution margin. If we drop the selling price by 20, that drops the contribution margin per unit down to 80. These numbers would look like this. We think we can sell 600 units times 80, that's the new contribution margin per unit, per speaker, $48,000. Our current contribution margin is $40,000. We've seen that number before. So our contribution margin would go up $8,000. That's the good part. Well, the not so good part, accounting-wise, is that we're going to spend $15,000 more in fixed expenses. That would cause us to reduce operating income by $7,000. So up here we have 3 changes. Selling price drops, advertising goes up, fixed cost, units go up in the sales, we do a quick calculation and find out, no, we really don't want to do this option because we would end up losing $7,000. You can go through the long way and do this, get the same number. So knowing contribution margin and how it relates to changes in fixed cost and selling price and so forth, we can get the number here with a quick calculation, or the long way, current situation, new situation, get the same number, the same result. In this situation, they're talking about paying the salespersons a commission of $15 per speaker sold rather than flat salaries that now total $6,000. They feel like this would increase sales by 15% up to 460 speakers. Should we do this? Well, first of all, our variable expenses would increase by $15 because of the sales commission per unit. So from 150 to 165. And then the fixed expenses would decrease from 35 down to 29. We're taking away the $6,000 in salaries. The new contribution margin is 85 per unit. So 460 speakers, the new total, times 85, 39.1. Contribution margin currently is at 40. And so it looks like, and we are decreasing the contribution margin. That's not so good. But overall, this is a good scenario because we avoid $6,000 in fixed cost. Yes, we lose $900 in contribution margin, but we save $6,000 in fixed cost, and so we increase net operating income by $5,100. So we would want to make this change. And a changing selling price, they're currently again selling 400 speakers. They think they can make a special sale here, a bulk sale of 150 speakers at a price they want to negotiate. This sale would not alter any of the regular sales and nor the fixed expenses be affected. So the question is, what price per speaker should be quoted to the wholesaler if our company, Acoustic Concepts, is seeking a profit of $3,000 on the bulk sale? Okay, well, we can ignore fixed costs in this situation. They are not affected. They are irrelevant. So if our cost is still, per speaker, variable cost, $150, and we want to make $3,000 in total when we sell 150 speakers, then divide, and there's $20 per speaker is the profit we're looking for. So we're going to not only cover our variable cost, but add a profit of $20 per speaker, and this will be a price of $170. So we can make a special sale at a special price to this wholesaler, and if we sell them 150 speakers at this price, we will have a profit of $3,000. So again, in this case, ignore fixed expenses because they do not change. Okay, so that was an in-depth look of a cost volume profit analysis with several examples. Next page. Let's look closer at break-even point and then add in there a target profit analysis concept. Now we talked about break-even point earlier. That's at the level where the company's profit is zero. That's the break-even point. There's a quick way to find it. There's the equation method, which I don't care about too much. I like this one the best. To me, it's easier to use. So what we'll do is take your total fixed expenses, place that in the numerator, divide that by your unit contribution margin. When you divide, the sales dollars cancel each other out, and the answer is in units. And this gives us the units we need to break even. Going back to our original numbers, if you can see this is awful small here. This is $35,000. Total fixed expenses divided by $100 contribution margin per unit. So again, $35,000, $100, divide, we get $350. And as I said, the dollar signs cancel each other out, so the answer is in units. So that is the break-even point in units. Now to get the break-even point in dollars, I'm going to go to the formula again. Take your same fixed expenses. In this case, let me break up a little bit more. $35,000 fixed expenses. But now divide by the contribution margin ratio, the 0.4%. So we don't have a dollar sign in the denominator. The dollar signs don't cancel out. So the answer is in dollars. So 0.4 into $35,000 gives us $87,500. That's the break-even point in dollars. And it's really as simple as that. So break-even point in units, up here, or in dollars. Now going one step past that, sometimes, well, I guess in most times, we don't want to just break even. We'd like to have a profit. So you might determine, okay, what is my target profit? And how many units do I have to sell to attain that target profit? Going to the formula method, there's only one change. In the numerator, we add the target profit to the fixed expenses. So if we want to have a profit of, let's say $40,000, and we still have fixed expenses of $35,000, we have $40,000 plus $35,000 in the numerator, so $75,000. Divide that by $100 unit contribution margin. The answer is $750. The dollar signs cancel each other out, so the answer is in units. So for us to make $40,000 in profit, we have to sell 750 units. If you want to find out what would our sales dollar level be at this profit level, very similar. Add your target profit to your fixed expenses. In this case, divide by your contribution margin ratio, the 0.4. You do that, the sales volume is $187,500. So at this sales dollar volume level, our profit will be $40,000. Back up here, at the 750 unit sales level, not dollars but units, we sell that, we make $40,000. So you can get the answer either in units or in sales dollars. Margin of safety. This is how far past the break-even point you are. So if we look down here, if our sales level is $100,000 and our break-even sales level is $87,500, then the margin of safety in dollars is $12,500. For the margin of safety percentage-wise, what we're going to do is divide the margin of safety, which is B, by the sales volume. This is A. So B divided by A, B is the margin of safety in dollars, divided by, up here, $100,000 in sales, 12.5%. So this just shows you how far past the break-even point that you are. Okay, next page. Here we're going to look at cost structure for a business and the trade-off between fixed cost and variable cost. The example they give us is that we have two farms, Bogside Farm and Sterling Farm. If you look at the numbers, for Bogside Farm, we have variable expenses that have a ratio of 60%, and contribution margin ratio is 40%. For Sterling, we have only a 30% variable expense ratio and a much higher contribution margin ratio of 70%. They both have $10,000 in profit as things stand right now. So the question is, which farm has the better cost structure? And of course the answer depends on many factors. In this example, if each farm experiences a 10% increase in sales with no increase in fixed cost, what will be the results? So we increase sales a little bit, 10%. Now with a 60% variable expense amount, then we have $66,000 in total variable expenses. Our contribution margin is $44,000. Fixed expenses don't change, so the net profit is $14,000. For Sterling Farm, we have, I'll just jump to it, we have a 70% contribution margin ratio. That means we go to $77,000 in contribution margin. We do have higher fixed expenses, but we do have a higher net operating income. This is because they are financed more through fixed expenses compared to Bogside. And once they hit the break-even point, then the more revenue they have coming in, the more goes to the bottom line. With a 70% contribution margin compared to 40, you have a lot more going to the bottom line than you would with just the 40%. What if sales drop below $100,000? Currently, back up here, we are at $100,000. Each one has profit of $10,000. What if we go below the $100,000 figure, though? So in this case, let's take a look at the fixed expenses and then divide by the contribution margin ratio. And what that's going to do is, we just saw this a page or two ago, that the break-even point in dollars will be the result. So fixed expenses divided by contribution margin ratio gives us the break-even point. You can see they're different between the two companies because Bogside Farm has a different amount of fixed expenses compared to Sterling, and also the contribution margin ratios are different. Let's look at the margin of safety. Current sales at 100. Here are the break-even sales we just computed. Drop those down. So we see that Bogside Farm has a much higher margin of safety at the $100,000 levels in sales than Sterling. So that means that Sterling must have $85,714 in sales to break even, whereas Bogside only needs $75,000 in sales. Contribution margin therefore is higher for Bogside. The margin of safety percent, 25% for Bogside, only 14.3% for Sterling. So you really cannot say that one is better than the other when you look at running your corporation with more variable expenses and less fixed, or vice versa. It just depends what's going to happen in the future. Will you exceed the level of sales you are now, or will you be lower than the level of sales? Both have their advantages, both have their disadvantages, but at least you can analyze the numbers and see the result when you assume one thing's going to happen compared to the other. The operating leverage is another quick tool here. It measures how sensitive net operating income is to a given percentage change in dollar sales. So operating leverage acts as a multiplier, and so if operating leverage is high, a small percentage increase in sales can produce a much larger percent increase in operating income. Let's see how this works. So at a given level of sales, here's the formula. We divide contribution margin by net operating income. That gives us a degree of operating leverage. This is not a percent, it's a number. The numbers here for Bogside is 4. If you can see these tiny numbers, it's contribution margin $40,000 divided by 10,000 in income. For Sterling Farm, 70,000 contribution margin divided by 10,000 in income. And so we have 4 for Bogside and 7 for Sterling. That's the degree of operating leverage. So this is not a percent, it's a number. It could be 4, it could be 4.2 or whatever. How do we use this? Down here, if we expect to have a 10% increase in sales, then we would take the 4, the operating leverage number, times that 10%, then we would expect to have a 40% increase in net operating income. So that's how we use this degree of operating leverage. If sales increase 10%, take the 4 times 10, this is for Bogside, operating income will increase 40%. Now for Sterling, though, it's going to be much higher because it has an operating leverage of 7. So 7 times 10%, that means its operating income should go up 70%. So the higher the operating leverage number, the higher your net operating income percent increase will be. Don't worry about this kind of chart here. I'm not going to ask you about this. And let's look at the next page. This is just saying that sometimes companies want to structure their commissions based on what's good for the salesperson and is also good for the company. So if you have sales commission based on sales dollars, a salesperson might try to sell a lower contribution margin unit. But if you base the sales commission on contribution margin, so I guess it's not really a sales commission. Well, I guess it is. Like a sales commission based on contribution margin per unit, then the highest contribution margin units will then try to be sold, and therefore the company will benefit as well as the salesperson. Okay, just a quick thing there, no big deal. And sales mix, don't worry about this area. No, don't worry about having different products at different prices and so forth. And I guess that's it for the chapter. So, sort of a detailed chapter, but it's a step back where we don't talk about journal entries again. We don't have any new kinds of statements to learn. We take what we know about cost we're learning in this course and applying it where we can make quick decisions on various assumptions. Okay, so reread the chapter closely and good luck with your studies.